20 years ago, IMF released its inaugural Global Financial Stability Report to strengthen surveillance of financial markets after a series of crises in emerging market economies and the dot-com bust. Having said that, we will be discussing on one of IMF blog posts themed as financial stability monitoring is always evolving from 1980s debt crisis to crypto era. Monitoring the health and outlook of the global economy and member countries is the bedrock of the fund's work. This surveillance role, outlined in amendments to Articles of Agreement, was adopted at the 1944 Bretton Woods Conference, charges with overseeing and safeguarding the international monetary system. In the early years, surveillance focused on the macroeconomic and exchange rate policies of member nations. But growth in international banking in the early 1970s highlighted a need to better track global capital markets and assess financial stability implications. Consequently, one started discussions with monetary authorities in major financial centers and in 1974 initiated internal reports on market developments and prospects. This demonstrates that the IMF's main multilateral surveillance tool has evolved with the increase in cross-border capital flows. Here in this figure, total external liabilities are in trillions of USD, and it has been presented for advanced economies as well as emerging market and developing economies since 1917 to 2020. Starting in 1980s, the report known as International Capital Markets became the main vehicle to monitor conditions in financial markets, warn of risks, and analyze disruptions like Latin America's debt crisis of the 1980s or Europe's exchange rate mechanism crisis in the early 1990s. But that era's rapid expansion and integration of global capital markets and the ensuing financial crisis in Asia and several other emerging markets highlighted the need to better assess systematic risks. Introduction of the Global Financial Stability Report, commonly known as GFSR, marked an important step forward to more comprehensive and frequent assessment of cross-border capital flows and financial market risks. In his foreword to the first GFSR, the then managing director, Post Kohler, noted how the report had its roots in crisis. Rapid expansion of financial markets has underlined the importance of a constant evaluation of the private sector capital flows that are engine of world economic growth, but sometimes at the core of crisis developments as well. Opportunities offered by the international capital markets for enhancing global prosperity must be balanced by a commitment to prevent debilitating financial crises. GFSR has since focused on identifying cyclical and structural vulnerabilities in the bank and non-bank sectors of advanced and emerging market economies. The risks they pose and the policy options to mitigate these risks. Vulnerabilities such as leverage tend to build up when financial conditions are easy and investor risk appetite is strong. And in times like that, stability reports place more emphasis on potential threats that are building. This reveals that Global Financial Stability Report adds emphasis on systematic vulnerabilities and risks when financial conditions are easier. This shows tightening of financial conditions or easing of financial conditions since 2002 to 2020. One of the most pivotal moments for the GFSR arrived in 2007 when contagion from the US housing slump shook the world's economies and markets. In a tightly integrated world, global financial crisis underscored just how critical it is to better connect the dots between institutions, sectors, and countries. Since then, Fund has increased its effort to analyze and understand interlinkages and systemic risks, cross-border interconnectedness, and spillovers, and the role of macroprudential policies in strengthening financial system resilience. In recent years, IMF have adopted a conceptual framework for more systematic assessment and monitoring of financial stability risks. It centers around vulnerabilities that amplify negative shocks, creating an adverse feedback loop between falling asset prices and tightening financial conditions, deleveraging by financial firms, and weakening economic activity. This exhibits the stability reports focus on macro financial linkages and emerging risks has increased since the global financial crisis. For the respective periods of 2002 to 8 and 2009 to 21. Empirical implementation of the framework relies on two tools: a broad set of key vulnerability indicators for the financial and real sectors, such as debt servicing capacity and the ratio of liquid assets to short term liabilities, that can serve as intermediate targets for macroprudential policies, namely capital buffers and liquidity coverage ratios, and an aggregate measure of how financial stability risks could affect expected global economic activity, which generally called as growth at risks. These tools are complementary for monitoring and policymaking purposes, as the granular analysis of specific exposures provides the necessary nuance and depth to the summary measures of threats to economic growth. GFSR has also actively called for an overhaul of the international regulatory landscape to address the gaps revealed by the global financial crisis. In addition, it has backed strengthening oversight of non-bank financial institutions, which have taken on a bigger role in intermediation since the crisis and could make the system more vulnerable. Continuous evolution in global financial markets, not least because of the dizzying pace of technological innovation, is always introducing new vulnerabilities and risks that demand constant vigilance. For instance, advent of fast and highly sophisticated computer technology has facilitated growth of high frequency trading, which can improve market efficiency but can also be a source of market instability. Other emerging technologies, such as artificial intelligence or AI and distributed ledger, are revolutionizing financial markets through fintech and crypto assets that carry opportunities but also fundamental risks that the GFSR is bringing to the fore. Climate change poses another stability threat that we are increasingly analyzing, along with the role that sustainable finance and the private sector can play in fostering a green transition. Enduring pandemic and war in Ukraine have further compounded financial risks by exacerbating pre-existing tragedies, contributing to the greatest inflationary pressures in decades and confronting international capital markets with greater risk of fragmentation. More than ever, rapid technological change as well as frequent and varied shocks make surveillance crucial for safeguarding international monetary and financial stability in order to promote growth and inclusion. And it's increasingly clear that to do so, most constantly adapt and sharpen tools for assessing risks to better scan the global financial landscape and strengthen its resilience. Today's presentation is based on IMF blog post dated 22nd June by Tobias Adrian, Natalushi, and Qureshi, themed as From 1980s Debt Crisis to Crypto Era. Thanks for watching.